Hello and welcome to the third episode of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. In this podcast, we'll delve into the latest M&A activity, upcoming spinoffs, significant buybacks, unique insider buying, activist campaigns, and more.
My name is Tamanna Suria, and if you're noticing a change in location from our prior episodes, you'd be right. I'm back at UCLA after the Los Angeles fires.
My name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area. We didn't have a whole lot of M&A activity last week, so we will be discussing a potential deal for TripAdvisor, as well as some really fascinating insider purchases that showed up last week.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
Let's begin by jumping into M&A activity this week. TripAdvisor received a proposal for $17.50 per share, and as we often see in these situations, the board decided that it wasn't in the best interest of shareholders to accept this deal, and they rejected the offer. There were no announced US M&A deals this week, so this was the only interesting thing we saw in the M&A landscape. As many analysts know, TripAdvisor appears cheap, and it also owns Viator, the travel experiences company that competes with Airbnb's experiences division. One of the challenges with TripAdvisor is that they have a dual class structure, with Liberty TripAdvisor owning a controlling stake in TripAdvisor with two different classes of shares, a Class A and a Class B share, with different voting rights. They are going to collapse this dual class structure later this year, and so we will see potentially increased investor interest in the company after this collapse happens. The way this is structured is it'll appear as a stock buyback, where the TripAdvisor company will be buying back the Liberty parent holding shares and will collapse both the Class A and Class B shares.
Let's move on to share repurchases. We saw a somewhat small but still interesting share repurchase announcement earlier this week at NB Bancorp, the holding company for the Massachusetts-based Needham Bank, which was founded all the way back in 1892. NB Bancorp went public a little over a year ago through an especially unique mechanism called a thrift conversion. We're going to take a moment to explain thrifts and thrift conversions because it's what makes this share repurchase so interesting. Thrifts, or mutually owned banks, are banks where depositors own the bank's capital. Unlike a typical bank, where the institution is owned and responsible to shareholders, a mutual bank like NB Bancorp is owned by the depositors who don't have voting rights in operations. When one of these banks chooses to go public, it is considered to be a mutual to stock conversion, otherwise known as a demutualization or a thrift conversion. In the IPO, depositors and insiders of the banks are the first ones to subscribe to the offering and finally own the capital in the bank. Unlike other IPOs where insiders often sell when the company goes public and not all IPO proceeds go to the company, the capital in a thrift conversion goes directly to the bank.
That's interesting. Due to the nature of the transaction, you're essentially buying into the thrifts at a discount when they go public, which is why the legendary investor Peter Lynch and other investors like Ed Thorpe were fond of thrift conversions and would often deposit money at small banks across America in the hope that the thrift conversion would happen eventually. There are a couple of things to note about thrift conversions and typical patterns that emerge. Around 10 of these conversions happen per year, and roughly 70% of thrift conversions get acquired by larger banks after 5 years of a completed conversion. These banks tend to repurchase shares frequently and see many insider purchases, especially during or right after the IPO. Insiders recognize the discount that the thrifts are priced at, often tend to go public at $10 per share, but almost all trade at below tangible book value. There are some rules surrounding these patterns. A thrift cannot repurchase shares until 1 year after the conversion and may not be acquired until 3 years after the completed conversion. James Royal has an excellent book focused simply on thrift conversions, and I learned a lot about thrift conversions by reading his book.
NB Bancorp fits this thrift conversion playbook to a T. We've seen consistent insider purchases at the company since it IPO'd, and when we first wrote about NB Bancorp's thrift conversion and the first set of insider purchases we saw at the company, the stock was trading at around $13 per share. Almost exactly a year later, NB Bancorp is sitting around $19 per share. And now that the share repurchase restriction has been lifted, the company has started to buy back stock. NB Bancorp announced earlier this week that it would repurchase up to approximately 2 million shares, or roughly 5% of all current shares outstanding. We like to track stocks where we see the company buying back stock while the insiders are purchasing shares on the open market, and we call this a double dipper. And that seems to be the case with NBBK. In fact, just as recently as today, January 24th, the CFO of NBBK just purchased shares on the open market.
So another interesting thing we are seeing right now on the stock buyback front is Netflix. So my family and I have been binge watching the show Lost on Netflix. This was a show that came out almost 20 years ago at this point. And it's quite fascinating, edge of the seat kind of thriller that keeps you hooked for multiple episodes, now that you can watch all episodes at the same time. But one of the things that struck out to us was that Netflix right now really has the lead when it comes to content. The only other thing that we probably watch is Apple TV, and it doesn't come close to both the quality and the quantity of content on Netflix. In fact, Netflix is planning on spending $18 billion on content just this year.
Right. So just this week, Netflix announced a $15 billion additional buyback, adding to an existing share repurchase authorization, bringing the total capital available for buybacks to approximately $17.1 billion. This follows absolutely stellar Q4 earnings, which were reported earlier this week, which created a $125 per share jump after hours. Netflix is now currently trading at around $977 per share. Revenue increased by 16% in Q4 year over year, and they now have 19 million new subscribers instead of the 9 million new subscribers that analysts were expecting. This was a big change from Q2 2022 when the company reported a loss of 1 million subscribers.
Yeah, that was an interesting time for Netflix stock. It dropped quite rapidly and it had dropped below $250 per share. Somewhere along that trajectory, Bill Ackman ended up buying shares through Pershing Square Capital, and then they ended up exiting very quickly as well. One of the reasons I decided to buy Netflix back then was I always felt the company had tremendous pricing power. It wouldn't be very difficult for them to raise prices, for example, by $1 or $2 per month. And the kind of attrition they would see for something like that would be low, was my thesis. And you're starting to see that. They are increasing prices on their plans. They are going after people who are sharing their password. And all of these things are adding up to increased revenue as well as increased earnings for the company. The company also has a hard charging culture where only the best survive. I was looking up Netflix on LinkedIn Premium and I noticed that the median tenure of employees at Netflix is only 3.5 years. In fact, headcount has shrunk 3% in the last 6 months and is down 4% over the last 2 years based on the data provided by LinkedIn. What is even more interesting for me is they have a very unique perk that allows employees to allocate as much as 100% of their salary to buying Netflix call options expiring in 10 years. So let's say Netflix stock was trading at $1,000 a share. Employees can choose to buy options for $400 and they can exercise those options at any point in the next 10 years to buy the stock at the $1,000 stock price. Based on my calculations, the stock price needs to rise over $2,300 and the company's market cap needs to approach $1 trillion for someone using this perk to make money, assuming they expect like a 15% per year return for a bet like this. 10 years is a really long time. The Netflix that we know today might be a completely different company from the Netflix that we see 10 years from now. So anything can happen. But just looking at the data right here, right now, it feels like this might not be the best bet, especially not putting 100% of your salary towards buying Netflix options.
Right, so this truly has been buyback week because General Electric, better known as GE, also announced a massive $7 billion buyback, marking the first buyback at the company in approximately 5 years. GE is incredibly operated. The company has created value for shareholders and optimized the business itself through a number of key decisions, including the spin-offs of GE Healthcare and the energy business GE Vernova in 2023 and 2024, respectively, leaving behind the key aerospace business.
When I was reading activist investment firm Elliott Management's letter to Honeywell, the playbook they were recommending reminded me very much of what Larry Culp has done at GE. And later in the letter, they explicitly call out the success of GE with its spin-offs.
These decisions have reflected very well in GE's stock price, which is up approximately 90% in the last year. GE Vernova, on the other hand, is up by over 200% since the spin-off.
The buyback bonanza continued last week with Twilio also announcing a very large buyback. Twilio is a cloud communications company that different companies use to send text messages and emails to their customers. So at one point, several years ago, if you were using Uber and you were notified that your car was waiting for you outside, that text message was sent through Twilio. I have a story about Twilio in the opening chapters of my book, The Event-Driven Edge in Investing. I followed this company for a really long time since before it went public and was surprised when the founder, Jeff Lawson, stepped down about a year ago. Over the last year, since the new CEO, Khozema Ship Chandler, took over, the stock is up nearly 90%. The company reported stronger than expected Q3 results, with revenue increasing 10%, and in its latest investor day guided to 11% revenue growth in Q4 as well. And they expect GAAP profitability in 2025. As you know, a lot of these tech companies report non-GAAP profitability, but once you include stock-based compensation, the GAAP profitability is usually negative. In addition to indicating that they will be GAAP profitable, they also announced a massive new $2 billion buyback, representing 11.5% of the market cap at announcement. Technology companies often announce large buybacks, and then you barely see the shares outstanding decrease because of the very high stock-based compensation that we were just talking about. This is not the case with Twilio, as they purchased shares aggressively in 2024 and retired more than 12% of their stock in the last 4 quarters. I can see why investors are once again very enthusiastic about Twilio. We are now going to switch to insider purchases. When I was on Andrew Walker's podcast a few weeks ago, he asked me if I was seeing insider buying in any specific sector that stood out. What we are seeing now is that biotechs and overall the healthcare sector is standing out. In our last Insider Weekends article, all 5 companies that made the top list of insider purchases for the prior week were healthcare companies, and most of them were biotechs. This is a time when overall insider activity is muted because we are in an earnings-related quiet period where insiders are not allowed to purchase their company stock before earnings are released, and often even for a couple of days after the release of earnings.
Right, so speaking of biotechs, we saw insider buying at Avadel once again, this time by director Linda Paltschuk, which brings our total count to 5 different insiders purchasing shares of the company. We discussed Avadel on last week's podcast, but just to recap, the company produces a sodium oxybate drug meant to treat narcolepsy and has created significant competition for the pharmaceutical giant Jazz Pharmaceuticals. As we discussed in the last podcast, Avadel enjoys massive advantages in this narcolepsy market, including the fact that their drug is considered to be clinically superior. However, the stock is down about 50% in the last year, and that could be due to the fact that concerns have been rising surrounding patients discontinuing the drug. Avadel, as we mentioned before, looks very strong financially, and we quite like the company at the moment. Q4 results are expected in early March and will provide more information and guidance about the company's future.
Another biotech company where we are seeing insider buying is Ardelyx. Ardelyx has an FDA-approved drug to treat irritable bowel syndrome with constipation, IBS-C. They also have another approved drug which is used by patients who are on dialysis, and it helps reduce the amount of phosphate absorption in the intestines. Patients with chronic kidney disease are unable to remove extra phosphate from the blood, which could lead to bone disorders, cardiovascular disease, and vascular calcification. The stock is down 35% over the last year because the Centers for Medicare and Medicaid Services made a change where starting January 2025, they won't pay separately for the drug like the one Ardelyx makes and will only make one bundled payment for dialysis treatment. 60% of Ardelyx drug sales related to phosphate are from Medicare patients. So what the company is doing now is they're asking doctors to continue providing the drug to patients for free, and they expect to work things out with Medicare and start getting reimbursed for the drug once again. We noticed that a director bought $1 million worth of stock this week.
Actually, we saw the same director, David Mott, purchase shares in November and December of last year, both purchases also totaling $1 million each.
The stock was down quite a bit over the last year, but once investors saw this $1 million purchase, stock jumped up 9% the next day. So they have two approved drugs. We are seeing revenue increase quarter by quarter. It looks like the company is at an inflection point in terms of earnings. It feels very much like deja vu, doesn't it, when we look at Avadel and this one. Revenue is increasing at a time when the beaten down biotech sector is seeing most of its stocks go down.
Yeah, so a lot of similarities and differences between the two companies, but both quite interesting on their own. Actually, just want to touch on a couple more interesting insider purchases. The list never seems to end. We saw director Kevin Johnson of Goldman Sachs purchase shares for the first time, approximately $1.49 million worth of stock. Mr. Johnson was the previous CEO of Starbucks for 5 years, from 2017 to 2022. He was at Starbucks for a total of 13 years, including 2 years as a chief operating officer. Later that same year, he joined Goldman as a director, and this week he made his first purchase since joining the board.
We don't normally talk about insider sales. Our focus is mostly on insider purchases because the signals are significantly higher from insider purchases. But we should mention that there's an upcoming massive sale of JP Morgan by its CEO, Jamie Dimon. The company indicated that he plans to sell almost 1 million shares of JP Morgan in the next few days or weeks. His purchase of JP Morgan a few years ago was very well timed. And because the market feels like it's very bubbly right now or near a top, this sale could also be very well timed. Another insider sale that I just wanted to briefly mention is that of the company RH, which previously used to be called Restoration Hardware. There was multiple sales at the company, and there was a short report recently calling attention to RH. We are now going to discuss spin-offs briefly. There was a new spin-off announced by Aptiv. This was a company that was spun out of General Motors in December 2017, and it resulted in two different companies at that time, Aptiv and Delphi Automotive. Aptiv is primarily an automotive components company, but also sells to aerospace and telecom, as well as industrial clients. Nearly 1/3 of its revenue comes from North America, but the company operates in 50 countries and gets a lot of its revenue from China as well. Aptiv is now spinning off its electric distribution systems division. The spin-off is a long way away, with expectations to complete the spin-off by March 2026. So that gives us a lot of time to understand whether it is the parent or the spin-off that we would be interested in investing in. We wrote about this company last year after it announced a huge $5 billion buyback that represented almost 25% of its market cap at announcement. The company decided to buy back $3 billion of that $5 billion buyback through an accelerated share repurchase. The thing that was really interesting about Aptiv at the point was when they made that $5 billion buyback announcement, 14% of the company's float was short and could have ignited a rally in the stock. The stock did go up almost 15% in the following 2 weeks, but eventually came back down when the company reported disappointing quarterly earnings. So what we're going to see now with the spin-off is it will potentially unlock value that the company couldn't necessarily pull off just through the stock buyback.
As I always like to say, let's transition over to C-suite transitions. The medical devices company Masimo, which makes devices such as pulse oximeters, just announced that they have a new CEO, Catherine Seisman. Massimo sued Apple for infringing on 10 of their patents to measure blood oxygen levels and heart rate, and managed to get the International Trade Commission to rule in its favor, which resulted on an import ban on certain models of the Apple Watch. As you would expect, Apple countersued Massimo, but it wasn't the Apple lawsuits that led to founder Joe Chiani's departure.
Yeah, so Massimo is a company I came across probably 12 or 14 years ago when I noticed an insider purchase by the CEO Joe Chiani. Massimo's CEO Joe Chiani departed the company mostly because an activist investor, Politan Capital Management, got involved and built a large stake in Massimo. They were not particularly happy about Massimo purchasing a company called Sound United for $1 billion in 2022 and waged a proxy battle and eventually got control of the board.
Now, the new CEO, Catherine Seisman, was at Edwards Life Sciences for 10 years. She was also on the board of Inari Medical, a medical devices company which focuses on deep vein thrombosis that was recently acquired by Stryker and a company that we talked about in our very first podcast. The most interesting part of her profile was that she spent 24 years at Medtronic. This appears to be someone with deep experience in the medical devices industry and is involved with companies for long periods of time. Surprisingly enough, we also saw that Medtronic has a new CFO. And that wraps up the third episode of the Special Situations Report. What we covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, like the merger arbitrage tool. Check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your special situations focused friends. Thank you.